been quite a week here in the UK.
Today, the Bank of England began to buy bonds to prop up the British government, warning that if the markets went on like this, there would be, and I quote, a material risk to Britain's financial stability.
The story becomes clear when you look at one of those assets. This is one of Britain's long-dated bonds. Look at how its price fell in recent days, causing that spiral for many funds. Then came the bank's intervention.
What do you think the end result is? I mean, we watched, before the Bank of England's move, we've been watching gilts, the yields soaring. We've been watching the pound get crushed. Now what? Is this a temporary fix from the Bank of England, or are they going to have to double or triple down to convince investors that they're really there backing this up?
On one part of town, the Chancellor has a stated growth objective of 2.5%. On the other part of town, the Bank of England's own view is that the growth potential of the UK economy is about 1% below that. That tension is now what we're seeing being resolved in financial markets.
Do we sell our house? This was meant to be our family house forever. I couldn't imagine us leaving. We're in a lovely area. It feels like the government are gambling on all our homes.
So not only did we have a crash in the pound triggered by massive tax cuts by the new government, but seemingly investors pulled the plug in one of the most dramatic events of the year. But it wasn't just your typical sell all your stocks and run away. This story just got a lot more complicated. You see, there are so many things going on at the moment, it's tough to make a sense of anything. How can one announcement from a new Chancellor and Prime Minister trigger a potential market crisis, crush the pound, and cause a mortgage crash, all seemingly at the same time? Well, let me try and make sense of all of this for you, and then also let's talk about if all of the problems we're having here in the UK might end up making their way over to the US too, because everything really is on edge at the moment. So all of this kicked off with some pretty big announcements from number 10 at the dispatch box. Liz Truss and Kwasi Kwarteng came in all guns blazing. Tax cuts for almost everyone, a cap on energy prices, stamp duty slashed, and just when you thought, that's quite a lot of money, are we sure we can afford this? Here comes the best bits.
Let's sit here and pretend otherwise. It didn't cap total remuneration. So as a consequence of this, Mr. Speaker, we are going to get rid of it. But I'm not going to cut the additional rate of tax today, Mr. Speaker. I'm going to abolish it altogether.
Just what people wanted. Christmas had come early. Now, the funny thing is, at this point, the pound absolutely took a nosedive, and in my last video, I went into all the details. But basically, the market was not impressed because in a time when we're meant to be keeping inflation under control and getting it back down, we're now going to be borrowing loads more money and cutting taxes. Watching this live was like when you watch Dragon's Den, but the people coming on the show clearly have no idea about their numbers.
And we don't intend to devalue its currency by mass marketing our crown.
So how many are you looking to sell in a year?
3.
3 crowns. You want £100 million for 1% of your company?
That's correct, yes. Yeah.
And you intend to sell 3 crowns a year at £100 each, minus costs, making you a net profit of £225.
Per unit, yes.
No, in total.
Oh, yeah.
Now, as I was trying to demonstrate there with help from Harry Enfield and Paul Whitehouse, effectively the markets and the Bank of England were pretty much left to pick up the pieces. And it's not just the pound that was left weakened. You see, at least over this week, investors really started to panic, not just in the stock market, but in the bond market. Because of the concerns that the UK government were just about to flood the system with even more money with tax cuts and borrowing, those who would normally be happy to buy bonds, basically government debt, had to think again, because who would want to buy something in pounds that were just being made weaker by inflation? At that point, you may as well just take your money and put it elsewhere. In the bond market, when there's less buyers around and nobody wants them, the yield on the bonds rises, which in theory starts to make them more attractive. After all, why would you want to give your money to a government and then lock it up for possibly many years unless you're going to get a good return? It makes total sense, right? Bonds are lower risk than stocks are, so you're not going to get 10% return, but you still want to get some kind of positive number because in the future, your pounds are going to be worth less and maybe a lot less with inflation. Hopefully that will make sense and I've not lost you. The issue this week, though, was that, according to the FT here, from Thursday, these long-term government bonds called gilts were really in trouble. I quote, "The process had put pension funds at risk of insolvency because the mass sell-offs pushed down further the price of gilts held by funds as assets, requiring them to stump up even more cash." And then here's a quote from an insider saying that at one point on Wednesday morning, there were no buyers at all. He adds that it wasn't quite a Lehman moment, but it was pretty close. So let's just quickly unpack this here, and I'm not claiming to be an expert, and I'm always happy to be corrected on the details, but essentially my understanding here is that pension funds, and we're talking about those who are supporting defined benefit types, so basically the kind of pension that provided you with a guaranteed income, mostly used in the public sector and pretty rare now, to my knowledge anyway, for new people. They're holding these long-term gilts in their portfolios alongside all of the usual stocks, shares and property, right? And they're also using them as some kind of leverage. It sounds like it's been a pretty normal practice to make sure they can keep meeting the needs of all of their members. After all, they've got to keep paying out all of this cash consistently. So what looks to have happened is that because of this incredibly volatile bond market with nobody wanting to buy them all of a sudden, their value's gone down, meaning that your pension fund is all of a sudden left with assets worth a lot less. And then because they were using them as some kind of hedge, they essentially got margin called for more cash. And again, let me quote the FT article here. If there were no intervention today, gilt yields could have gone up 7 to 8% from 4.5% this morning. And in that situation, around 90% of UK pension funds would have run out of collateral. Okay, that's pretty bad. Anyone got any ideas of how we get ourselves out of this situation? Dragons, what's next?
It's like sellotape, yes, but without the sticky bit.
Right, so it's almost like all of that mess that went on with the lunar cryptocurrency. You're taking out loans or using your bonds as assets, but the moment they stop being worth as much, then you're pretty much screwed. Sounds like a sustainable system to me. Seriously, because this subject is quite complicated, I doubt that any of the news channels will explain this properly enough to us that people's pension incomes were literally put at stake because of government incompetence. What a mess. Now, sorry to keep on the negative train, but we've just got to unpack everything here and we can focus on some positives hopefully at the end. But you might have also seen this week that the mortgage market is also in a slight crisis because, again, of everything going on with the bond market, interest rates and inflation. Mortgages for us in the UK are set to get a lot more expensive. And really it all depends on where you are. And I'm not just talking geography, I mean what stage you're at. Firstly, you've got mortgage deals being pulled away from the market at a rate we've never seen before.
More than 1,600 have been taken off. 935 on Tuesday in a record one-day fall, more than double the previous drop at the start of the pandemic in April 2020, and a further 321 in the last 24 hours to 2,340.
Then you've also got those deals getting more expensive very, very quickly.
Average 5-year fixed mortgage was at 2.64%. That has almost doubled to 4.83%.
You might have also seen on Question Time last night a lady talking about her deal as a first-time buyer. Just listen to this.
Yeah, I just want to know what the plan is for mortgages because I was actually in the process of getting a mortgage as a young person and I was told my initial interest rate would be 4.5%. And I was told today that the lender has pulled that offer and now the best offer that I can get is about 10.5%.
You can hear the reaction in the air. People are getting pretty annoyed. Now again, let's just keep this simple. What does this mean for the property market? Well, if rates go up for borrowers, it just means that you'll have to pay more interest when you go to refinance. For anyone not from the UK, we don't have any of these 30-year loans for houses. Most people fix for a period of 2 to 5 years and then they'll just keep refinancing or they'll stay on a tracking rate. We've pretty much had it really cheap since the financial crisis and house prices have seen a pretty much straight line rise in only one direction. Now the markets are predicting that in order to combat inflation, interest rate hikes will probably push us closer to 6%. And to put this in perspective, this means that someone paying something like £900 on average a mortgage for a month is probably looking at something like £1,150, but as you've just heard, it really will all depend now. If you managed to lock yourself in recently for a few years, you can count yourself lucky, but there will probably be a lot of people out there potentially left in a position where they won't be able to afford their mortgage and might have to sell their homes, which could then lead to some major corrections in the housing market. And before people start saying they shouldn't have borrowed up to their eyeballs, even with a stress test, you've got crazy inflation and energy bills set to soar, so I don't think you could see that one coming. Now, with all of this said, is there a silver lining? I'm a positive channel after all, do try and help. What can we do as investors? Can we really do much? Well, like I mentioned in my last video, staying well diversified is really important and making sure that you aren't too reliant on the pound, that will definitely help. But also, if you did have some cash on the side or you're based outside of the UK, like a US investor for example, you're in a serious position to have a good shop around here. There's definitely some FTSE 100 stocks that are really down in the dumps and pay pretty high dividends, and they're going to be around for a very long time to come. And not only that, one area that deserves another look in a separate video is the property market. And this time, not just residential, but commercial and other areas like that. If you look at some of the biggest real estate investment trusts on the London Stock Exchange, some of them are down massively. And we're talking about the biggest blue chip ones here, things like Tritax Big Box, who rent out big warehouses to online retailers. Year to date, they're down 46%. And then even other ones like Unite, who focus on student accommodation, that's also down almost near 2020 pandemic levels. Now, I'm not a shareholder, and please do your own research, but usual caveats and all that apply. But there could be massive opportunity where there's fear and uncertainty. So it's all just part of the investing and part of the game. Anyway, on that note, where do things go from here? If anything changes, I'll keep you posted on another video. Until then, stay safe out there, drop me a like, subscribe for more, and as always, happy investing.